Now, it's no secret that competition is rife in Australia's home loan market, with lenders fighting tooth and nail over borrowers amid record levels of refinancing, driving some lenders to even make rate cuts despite moves from the RBA. Non-bank lenders play an important role in this market competition, challenging major banks to stay on their toes with sharp rates and good technology. So on that note, I'm pleased to say we're joined by Brodie Haupt, co-founder and CEO of one of Australia's leading non-bank lenders, Wealth. Brodie, welcome to the Savings Tip Jar podcast.
Thanks for having me, gents.
It's good to have you on here, Brodie. So we'll first talk about the big elephant in the room, the RBA and their movement on Tuesday afternoon. I noted earlier that you at Wealth could kind of see it coming. So what does this hike mean? How high will the RBA go? And what does this mean for a lender? You know, you talked about bond yields and things like that, but what does this mean for Wealth?
Yeah, it's actually a really good question. And, even a lot of the experts in the space have been struggling to ascertain where the RBA is going. And there's obviously been a lot of media come out about the structure of the RBA and the new RBA board that's been put forward as well. So, look, we had a little bit of internal information that helped us get ahead of understanding where the RBA would go with this rate rise, and that's purely based on the source of our funds. So we're not a balance sheet lender. We source funds from a warehouse facility, and then we on-lend them to our customers. So we've got a really close relationship with the two warehouse funders that we utilise, and speaking with them about some of the bond yields and bond rates and the cycles that are happening, they could anticipate that we're going to have probably one more interest rate rise, which went through on Tuesday. Just to test, I suppose, the economy itself and also push, I suppose, a lot of the consumers in the space to see if we can understand where inflation is going. And I suppose for the RBA, this will probably be the last one for now. They'll wait for the next results of inflation results to come out and then make a decision from there. The good news, I suppose, from our perspective, is that we're predicting still that probably towards the end of this year, by sort of Q3, September, October, we feel that the RBA will either hold for a longer period or start to tail off and drop off a backward cycle, which will be a huge relief for a lot of household borrowers. I mean, we've been looking at different product structuring about how we can create a little bit more flexibility and less stress for homeowners. Household pressure is stress saver. 2-year fixed only owner-occupied loan, so the borrower is only paying for the interest-only proportion for a 2-year period, just so that they can ride this interest rate rising wave and make sure that they've got security around their repayments, and their repayments will be less than what their principal and interest repayments would have been if they're moving from a principal interest to an interest-only owner-occupied product.
Now, Brodie, as I mentioned earlier, we're seeing so much competition in Australia's home loan market. And I guess one of the major challenges for non-bank lenders such as Wealth is a lot of the cashback offers that some of the kind of bigger banks have been offering. We've seen some offering up to $5,000 or even $6,000 cashback to people refinancing. But there's early signs that these could be winding down a bit. With UBank, I've noticed they're actually no longer offering this month. They're very generous $5,000 cashback. Just generally, what's your take on these cashback offers, and are these winding down?
Actually, I wasn't prepared for this question, but it's an awesome one. We have this conversation internally all the time. What we see it as is the major banks failing really to understand their unit economics around the cost of acquisition for a customer. They've become quite lazy. So rather than trying to generate and invest in education to their borrowers and customers, they go, look, for retention, rather than you moving, the CBA being really guilty of this, they're offering upwards of in some cases $7,000 to retain a customer, just because they don't want to lose them, and they know that their customer acquisition cost is higher than that when you're looking at that unit economic of cost per settled loan. So we focus heavily on education. We're focusing heavily on our unit economics and our business model, whereby we're not trying to offer huge cashback incentives for customers, but rather talk to customers about how they can be more purposeful with their money. And that talks to our partnership with Parlay for the Oceans and what we're doing in that space as well. So for every loan that settles, we empower Parlay for the Oceans to clean up 50 square metres of Australian coastline and beaches from marine plastic and marine debris.
For sure. And that kind of takes care of one of my later questions, but we'll pivot slightly to more of the wealth story. So I think I've gotten some comments from you and your brother Drew before for a wealth story that we did a couple of years ago. And what stuck out to me was that you guys are very sort of ocean-based people. You know, you like getting out on the water and things like that. So can you tell us how did wealth sort of come about, and tell us some of the backstory to establishing a lender with your brother, and go a bit further into the push for the Cleaning Up the Oceans initiative?
Yeah, for sure. So our story, and I've said it many times now, our story really has been probably a more different one to your generic neobank or lender stories where the founders have generally come out of an institutional bank. Our story has really come from the entrepreneurial side of it and looking at a customer focus when we're thinking about creating product and creating business ideas. But for us, it's almost been about how do we solve inflection points or solve objections or irrational components of an industry. So for us, we had a property advisory, we then went into finance brokering, we then went into fintech. We have a PFM tool that we recently sold, which is a personal finance manager app called Money Management. We've got a prop tech tool called Propalytics. And it's always been about trying to level up the customer experience. Playing in tech and finance led us almost organically to create wealth. And we could take it with a blank canvas. So I studied the Australian banking license, or the restricted banking license, as part of my thesis with Oxford University when I did the fintech program there, and understood that it was a pretty, how would you say it, kindergarten version of reality, and there was no commercial basis for it. That's pretty harsh, but it's pretty black and white in my eyes. And we thought, rather than trying to create another neobank, and we've now seen multiple of them set up, raise a hell of a low capital, stumble, trip and fall, because the basic core foundations of the business doesn't make sense. So we looked at it as, let's become a non-bank lender, let's become a digital lender first, and then that'll be the core revenue providing component to our business, from where then we can build out our rest of our ecosystem and product roadmap. With that, we said to ourselves, we really want to overlay and have at the core of our DNA purpose, or purpose-led initiative. We have an affinity with the oceans, being in Australia, growing up surfing and sailing, being by the beach, most Australians do. And this was an issue that we landed on, and we were lucky enough to, it's a lot of work, and as I'm sure you could understand and respect, but we brought together our card manufacturer, which is Giuseppe Deveron, and Parlay for the Oceans, and wealth, and thought from the outset of the business, let's make sure that everything that's tied to generating revenue also creates impact. And we're seeing the benefits of that now that we've gone from sort of a startup business into a scale-up style operation. We're seeing that the consumer sentiment towards wanting to do something positive with money, because it's a bit of a taboo sort of subject in Australia, particularly around lending and loans, and turning into a positive, and they can be part of that community and drive real change. We're winning business that way. We're winning customers, but we're winning a community, which we're really proud of. The other, I suppose, big point of difference of us as a lender compared to your other digital lenders in the space, like the Athenas, the TikToks, and the 86400, which is Nubank, as you referenced before, is we always had a mandate to go out as a dual channel distribution source, so to support direct to consumer, but also to support the biggest part of the market, which is finance brokers. They account for writing in excess of 72% of all loans currently in the residential and commercial property sector. And then more recently, we've focused on widening our breadth in terms of our product range to make sure that we're helping brokers win business when we're in a downside of the market. So we had a lot of growth in the lending space through 2021, 2020 and 2022. That's tailed off a little bit this year. So we're looking at more niche-based products, like getting into the SMSF lending space and being super competitive in that sector. I mean, that sector speaks to $127 billion worth right now in terms of the size of it, and it's only a growing sector. There's over 1.1 million self-managed super funds set up in Australia. Over 750,000 of them have limited recourse borrowing arrangements, which is SMSF lending for property. People are trying to take control back from the big super funds. So it's understanding and identifying different components of the industry where we can make a difference.
Just on a slightly different, I mean, you mentioned weighing up the commercial viability of becoming a bank and instead deciding to focus on being a non-bank. Obviously, non-bank lenders, they come with advantages and disadvantages. I guess, maybe one of the disadvantages could be that some people have this stigma attached to non-bank lenders that you can't really trust them, you can't really borrow from them. Can you expand a little bit on some of the advantages and disadvantages of non-bank lending?
Sure. I mean, there's multiple layers to that question. It's a really good one. First of all, from our perspective, we're always thinking about the customer, so the customer experience. The general disadvantages of non-bank lending in the past or lending from mortgage managers has been the difference or the siloing of each loan into a different customer portal. So you have one loan funded here by XYZ, one loan funded here by a different funding warehouse or a different solution or a different funding source or a different customer portal. So we've solved for that. We've brought in our own single customer portal, the Wealth Portal, which brings in multiple sources of funding, displays it in one customer portal and has all the security led elements in there. We have the same capability as any digital or neobank. We have the same capability. We've got cards in market, recycled, world first, which we're super proud of. These are recycled ocean plastic cards. We have fully functioning offsets, multiple offsets. We've got all the bells and whistles features. It's a beautiful experience for the customer. So for us, that's the first thing that you have to tackle head on and solve for. The second component around trust is just about helping and educating your customers and also brokers about what it looks like. Why are people carrying that sentiment of not trusting a non-bank? Is it around the financial claim scheme? If we partner with an ADI, which an ADI supplies our offset accounts, does that secure the customer under that same scheme? So it's about changing the narrative and helping drive education. And consumers are smart. For too long, the banks have marketed to consumers like they're monkeys or they're idiots, which we take the opposite sentiment. We think, let's give them all the information. Sure, they may not understand it all, but let's then help take them through that journey and bring them along for the ride.
Brodie, before we wrap up, I think I'll just ask, it's a bit of a two-pronged question. So one of the sort of talking points in recent years has been home loan approval times. We saw with the big banks in the sort of COVID years that approval times were blowing out massively. So how fast on average, you don't need to go into any hard numbers or whatever, but how fast generally can Wealth approve a home loan? And off the back of that, are there any sort of announcements you'd like to make with Wealth, any new features you're adding or any developments with Wealth?
Yep, so happy to answer all those questions. First of all, our current turnaround time is 48 hours. On average.
Quick.
So that's our SLA internally. We are in final UAT testing for our decision engine. So we're having our whole product suite pushing through a decision engine for instant approval, which we're launching to brokers first. So we'll be the first digital lender or the first lender in Australia that supports brokers through an end-to-end instant approval process. So that's in testing right now. We've also just about launched our broker portal version 2, which gives finance brokers, again, talk about customer experience, talking about the broker experience, who are our distributors, they are our ambassadors for our brand, bringing in all of their deals into one single portal, showing how much impact they've created with Parley, showing all of their digitised forms, servicing calculators, commission statements, everything all in one self-serve kiosk. But then tying that back in and integrating that with our decision engine will enable a broker to go on, apply for a loan, as long as they've got all of the outstanding information and documentation they're ready to upload into the system, we'll be able to skip them back an instant approval, which we're super excited about.
Yeah, well, I guess with more than half of Australians opting to go through a broker than direct with a lender, I guess, brokers are always going to remain that key pillar of the mortgage broking industry. But yeah, Brodie, I'm afraid that's all we've got time for. Really appreciate your insights, and thanks so much for joining us on the Savings Tip Jar podcast.
Pleasure's all mine, gentlemen. Thank you so much.
Thanks, Brodie.